Hi, welcome to Financial Launchpad, a podcast designed to teach you about personal finance by starting with the basics and progressing to more complicated topics. We'll tackle a new topic every week and provide additional resources to learn even more and action items to launch your personal finance journey. I'm your host, Emily, here with Sam.
Hello.
And thank you for joining us as we kick off our investing series with discussing the mindset you should have for investing. So to kick this off, I want to clarify that basically for this episode, my primary target audience are people in their 20s and 30s. Not to say that older people can't benefit from it, but I'm just telling you that is who I'm talking to primarily. So when we talk about investing, I just want to really emphasize that I don't think that this is an optional thing. And I think that it's honestly something that everybody needs to start doing sooner rather than later. And we can get into a little bit of the numbers right now. Basically talking about active income versus passive income. So active income is obviously money that you get for working a job. You know, you're trading your hours, you're trading your time for money. And if you ever want to stop trading your time for money, you need to have a different way to earn money, basically, which involves saving and investing and not spending every single penny that you have right now so that you can invest. And it used to be a little bit more that you could rely on potentially Social Security, a pension or whatever, and you could be slightly more passive. But honestly, I think that era is basically gone. And I know that there's so much talk about Social Security, and I'm not going to get into that right now. But honestly, for our estimating, I try not to rely on it. The more realistic reports say that for people my age, I'm just under 30, it most likely won't be completely gone by the time that we hit retirement age. But personally, I just don't want to rely on it. So that means that we have to be saving money now in order to have passive income later, as essentially you're making money while you sleep. If you never figure out how to make money while you sleep, you're going to have to trade your time for money for the rest of your life is what it comes down to. And retirement ideally is where you stop trading your time for money and you have this nice nest egg that is passively earning income that you can just draw from. So that is to me the importance of investing and why everybody needs to be investing and saving for the future, no matter how much you want to spend money on fun things right now. And I know that Sam has talked about struggling with that a little bit.
It is difficult getting your head wrapped around the idea of putting a fairly substantial amount of your income toward your future. Because, it might be nice to get new versions of anything you may have or something completely new to you, fun tech, good games, movies, whatever you can think of or want. But you really kind of need to focus on your future as much as your fun time now.
Mm-hmm. So that we can actually enjoy our future when the time comes.
Right, because I could plan to work my entire life, but that's probably not going to happen.
Yeah, we can't all be your grandfather.
No, we can't.
Sam's grandpa is in his late 80s, and he is so sharp still, but he still works. I mean, he enjoys it, and he hasn't been deemed a major threat to the road yet. But yeah, he likes working into his 80s, and people are always amazed that he's in his late 80s and still working. But it's just not something that you want to rely on.
Whether you want to think you could or not, it's not something you should plan to do, at least.
Mm-hmm. Yeah. If you are able to keep working and you want to keep working and you're enjoying something, nobody's going to turn down an extra 10 grand a year. If it's 10 grand that you don't have to take out of your retirement accounts, that makes a gigantic difference later on. I mean, obviously adjusted for inflation, but pretending that we're talking in today's dollars, an extra 10 grand can go a long way. I mean, that could be a couple of nice vacations, honestly.
Oh, yeah.
If you want to splurge. But yeah, obviously, delaying some of the gratification now. Not saying that we're denying ourselves completely in order to save for retirement. We still do fun things. We still do vacations. Sam still gets new computer components when he tells me that whatever he has is no longer sufficient. But he doesn't spend all of our money on it, and that's the important thing.
It only kills me a little bit.
Even though he would like to spend all of our money on it. But yeah. So getting a little bit more into the mentality that you need to have for investing. honestly, it can be as complicated as you want it to be. Truly, I think that at its most basic, reasonable, least complicated level, everybody can learn about investing and do it properly and, not have too much of an issue. Right now, a lot of people make a lot of money by trying to convince you that these things are way too out of reach for you to do on your own and that you always need outside help. I'm not saying that there aren't complicated situations. There are definitely complicated situations. A friend of mine basically owns a business and he starts asking me about business things and I go, whoa, time out. I have no idea what you're talking about. That's not what I understand. Not saying that he couldn't learn it, but that's just where my limitation is. But for an individual investor, you can get to a point where you just can learn a little bit more than you do right now. And we'll be going through all of this with this investing series and do okay for yourself. So just get it out of your head that it's way too complicated for you to understand, because I just think that that's a lie, honestly. And what do you think, Sam? But I've been kind of teaching him a little bit of the things that I've been learning slowly and getting him warmed up to it.
Slowly, because I'm a slow learner. No. Thank you. It's been a fairly seamless transition from having the assistance Emily mentioned earlier, from going from having a financial advisor, someone taking care of our Roths or keeping an eye on our Roths, to taking
Roth IRAs. Yes. That's one of my bad things, is that there's more than one type of Roth. So our Roth IRAs.
Our Roth IRAs. From having somebody manage that for us to managing it ourselves. And fortunately, Emily has been doing a lot of research to figure out how a lot of these things work and like the minutia of how these things work versus like how easy it actually is. Like, she's gone through all this stuff. She's looked at a lot of things and found how simple it really can be just to do it yourself. Mm-hmm.
If you want to complicate it, we can talk. There are ways to complicate it, but that's really not necessary. All right. And so on that note of, complicating as much as you want it to be, even if you're not an expert on the topic, my hope is that after these podcasts, you can become comfortable enough to do something that's at least better than what you were doing. And don't worry about chasing, the perfect portfolio or the perfect method. One of my favorite quotes is, "Perfect can be the enemy of good." As you're striving for perfection, it may make you not do anything because you don't know what the perfect strategy is. And you can be chasing the perfect thing rather than just doing something that's okay and it's good enough. And if you do good enough for your entire life, you're going to be fine. You're going to be in a lot better situation than some other people are. So just keep that in mind, is that good is still good. Good is better than nothing. So don't just be chasing the perfect strategy. So going back to just basically, you need to be in charge of your finances. That's what we did this year. And it's honestly been liberating, because it's not like even before this, when we did have a financial advisor in charge of our Roth IRAs, I felt like nobody was really in charge of it, because I still kind of had to have a handle on the 401k, which I did not understand my 401k and all those options necessarily. And somebody else was kind of looking over our Roth IRAs, but nobody was really looking at the overarching picture of how all of these accounts work together necessarily. We would kind of supply a few, numbers to our financial advisor, and he'd just, throw it in the calculator and be like, yeah, you're doing okay, or you should actually bump up your contributions and stuff. But nobody was really in charge of it completely until I decided to learn it and I took charge of everything. And this could have easily been Sam. It's just that in the personal finance world, especially among couples, people like to say that there's the nerd in the group and the free spirit, and I am definitely the nerd. Sam is also a nerd, but not necessarily when it comes to finances and the math aspects. So, it really could have been either of us, and I still try to make it both of us, but I try to shelter him a little bit from the things that I just enjoy getting into, honestly, that overwhelm him, and there's no reason for him to know about it or anything. But really, once again, you need to be in charge of your financial future. And unless you're paying someone big bucks to specifically manage everything that you're doing, I really think that it has to be you. That's just how it comes down to it. And I feel like now our portfolio is so much more cohesive than it was before, even when somebody was supposedly helping us. So as you become in charge of your finances, you need to learn enough to understand things. And really, I encourage you to not invest in something that you don't understand. If you can't do some research and learn it, you're not going to inherently understand everything. But if you can't do some, hour research on some fund or portfolio or investment vehicle and not understand what's going on, then honestly, I don't think that you should be investing in it. Even if somebody's telling you to sometimes, you need to understand what you're doing with your money. And if things get so complicated that you really can't even learn them, it could be more like a scam product, honestly, or a riskier business proposition that, you can't get your head around and you're just not comfortable with it. Then consider not actually doing that.
So you're talking about like potentially mutual funds even, or trying to invest in a single company or product. Mm-hmm. Okay. Mm-hmm.
Or, there are just a lot of other more complicated methods of dividend investing, and even potentially annuities can kind of be a trap, or whole life insurance, or just life insurance in general. There are just a lot of products out there and those sorts of things that can be complicated. They're complicated to understand. And honestly, there have been a few of them that I go, nope, this isn't as simple as I want it to be. And I know that there are simple options out there that truly don't take very long to understand. They make logical sense to me. And that's what I prefer to go with. Sometimes the simple approach can be better. Obviously, once again, research, figure out what you feel comfortable with. But, even with me telling you to potentially open up a Roth IRA and invest in an index fund, I don't want you doing that until you feel like you actually know what's going on. And my hope is that I can give you information that you can also research on your own and become comfortable with that. But I think that that's just still really critical, is just don't invest in anything that you don't understand, because the things that I think that you should be investing in, I don't think take that long to understand, quite honestly. They're just not that complicated. And when things get complicated, that's when it just gets trickier to do.
Getting into the weeds isn't for everybody. Not even like getting into the weeds. Mm-hmm. But for some people, finances either stresses you out too much or just isn't your forte. And taking control of it on your own, though it may debatably be better, there are perfectly legitimate companies and groups that will help you. Mm-hmm. And you will be nearly as well off in the future if you do have someone's professional paid assistance, mm-hmm. versus trying to take care of it all yourself. Does that make sense?
Yeah, that does make sense.
So, it's great to try to take care of it yourself. And I appreciate the fact that you've taken the initiative to get that running for us. But if you truly aren't comfortable with it, or you're just nervous and you need someone's help, like we could have stuck with our financial advisor. Mm-hmm. And again, I know that we would have been receiving 1% less a year or whatever, which does have a fairly significant end result.
Sam is just spoiling all my future episodes.
But anyway, it's like you don't have to do this yourself.
True.
You can. It's not that bad, but if you really aren't comfortable,
yep,
you can have somebody else's assistance, whether it's Emily's assistance getting yourself started, or if it's the assistance of a professional financial advisor, fiduciary, whoever you can find that you trust. You will be better well off than if you just throw all your money in a savings account or do nothing.
You're right. And this is part of the reason why Sam is discussing this with me, because I get all gung-ho and he's like, let's ratchet it back a notch. And like what I was saying, perfect being the enemy of good. In my mind, perfect is dealing with it all on your own. But if you need a financial advisor, at least for the beginning few years, like what we had, to at least get started and get a taste for it, that is not the worst thing in the world. There are also robo-advisors that I would argue are a good option. But I will be getting into some of my ideas on financial advisors and, like Sam said, fiduciary. That's the magic word, fiduciary. We'll be getting into that a little bit later. And, of course, the effects of fees. That's what Sam was talking about with paying somebody 1%, which doesn't seem like a lot, but it becomes a lot later on. We'll talk all about that. But Sam's got a great point that I am arguing that you need to learn enough to manage this mostly on your own, and Sam is reminding all of us that getting outside help is not the worst thing in the world.
Especially in the beginning.
In the beginning.
If you take a little bit of time, once a day, once a week, however often you want to, maybe just after you talk to your financial advisor twice a year, just to understand a little bit more about how this works, then maybe you can start exploring the idea of going out on your own. But having somebody else's help in the beginning is not the worst thing.
Yeah. Though I would honestly argue that with our financial advisor, just personally speaking, and I wasn't going to get into it now, but I think it's still important. I would ask questions and I would get some answers, but it wasn't quite what I wanted. Honestly, like I'm a lot more satisfied by doing my own Google searches and obviously, looking at multiple sites, multiple sources to make sure that everybody's telling me the same thing. I'm a lot more satisfied with that because now I can identify what we were actually getting out of the financial advisor. And that's honestly what I plan to present to you guys is basically what we had, where you have the asset allocation quiz and discussing that, and we'll get into that later. I know that that's a buzzword.
The weeds.
It's not the weeds. That's highly important. But honestly, like, I feel like even with our financial advisor, it was basically putting almost blind trust in him. And I'm now no longer comfortable with that. And I wasn't comfortable with it for a little while. And then I finally just got the nerve to start researching more on my own and gaining confidence just because I wasn't quite getting the answers that I wanted out of him all the time. And I could tell that there was this disconnect when I was, asking, well, how should we invest in our 401k? And, he can't give us specific information necessarily for it because he wasn't managing our 401k. So it's that disconnect that really encouraged me to learn this on my own. So a financial advisor is not the worst thing. If it gets you investing, that is fine. But I'm honestly trying to save you our step, I suppose, and our years of, losing out to some fees and loaded funds and all of that. And this is more getting into the weeds, but that's where I'm coming from, is having had a financial advisor for a few years and realizing what we got out of it. That's what I want to present to you so that you just can save that step, quite honestly. And our guy wasn't the worst thing in the world. It's just I found better options. That's all.
Right.
All right. So getting into once again, the importance of investing. I have some numbers for you that are really quite astounding. So you might currently have a nice little nest egg that's in your savings account that you've earmarked toward retirement. And I think that's great. If you can get in the habit of saving, that's like half the battle, honestly. Earmarking and all that. But this example is really to tell you how much your money can and should be working for you. Okay. So I talked about, having $1 million essentially invested by the time that you retire, and talking about how I think that that's honestly necessary in order to have a comfortable retirement. So here are some numbers that I threw into a calculator, and there's a lot of them around. It's really nothing magical. It's all just compounding interest. So if we're shooting for roughly $1 million net worth at age 65, and pretending that we started investing at age 25, and I know that a lot of you are a little bit older than that, but that's okay. Just bear with me. So we start at 25. You have nothing saved for retirement, and say you decide to contribute $500 a month. That might seem like a small amount. That might seem like an astronomical amount right now. I would guess that if you have student loans, that could be about the amount that you're paying right now in student loans. So imagine, repurposing that after your student loans are paid off to investing. But say that you invest $500 a month and it accrues for 40 years. You invest $500 a month for 40 years. So the amount that you've put in that time is $240,000, which is an awful lot of money. I mean, that is not chump change. But assuming a 6% annual return, which is fairly conservative by many standards, a reasonable return, and that would basically put it in today's dollars, because you could possibly expect about 9%, and then subtracting off that 3% for inflation, that's how we get to the 6% figure. So we are talking primarily in today's dollars, give or take a little bit. So you have $500 a month invested every month for 40 years and compounding at 6%, you would end up with nearly $1 million after only investing, you personally, $240,000 of that. Your growth would be about $750,000. I mean, that is just incredible. You know, can you imagine saving enough money just on your own in order to have $1 million? It requires a little over $2,000 a month. I mean, it's 4 times the amount. If you aren't including any compounding interest, like I said, if you have it saved in that savings account, which honestly, if it's earning anything less than 3% in that savings account, you're technically losing money because you're not even keeping up with inflation. But you need to get compounding interest working for you so that you can put in less and still come up with a lot of money. I'm not saying that $1 million is necessarily what you need to have in your account. It might be more, it might be less. This is just an example of really that power of compounding interest. It's more just so that you don't have to rely on yourself to save that $1 million. Like, let compounding interest work for you.
So it's easy to hear that number, but it's much harder when you're starting off, because even with a conservative 6% growth, for the first several years, I mean, many years, almost a decade, the growth, at least the number that comes out of it, isn't that impressive. But as it grows, as Emily said, it's compounding. So everything grows more quickly and more quickly. So the amount of money you make this decade is so-so, but the decade after that is significantly more, and the decade after that is significantly more. And by the time it's been 40 years, you put in $240,000, you make $750,000 in growth
for a total of roughly $1 million, and you only contributed a quarter of that. 75% of it is growth, and it's all because of that compounding interest, which means that you accrue interest and you basically tell your account to reinvest that. You know, if you make $20 one month, you don't take it out or anything. You say, okay, reinvest that, buy more shares. So you make money on top of the money that you've already earned. And that's when it really just kind of blows up. Like Sam said, it's exponential. So it looks very linear in the beginning and it's hard to see that progress. And then once you build that nest egg and you get some decent years, it really takes off. But with all of this, we know that the stock market's volatile. And honestly, they talk about it on the news all the time. You know, just today they were talking about the stock market being down. And
today being Monday, May 6th. Just so,
yes.
We did not record this on Thursday or Friday whenever this is released.
Yeah. I want you to drown that out. Like, this is the most important part of this episode, honestly, is the critical mindset of buying and holding. Okay, once again, the complicated, the attractive, way of investing where they talk about buying individual stocks and, buying low and selling high and all of this other crap. It is crap for the common and normal investor. And you need to put it out of your mind. We are in a buy and hold mentality, especially in our 20s and 30s. We've got decades for this money to grow. And over those decades, hopefully the trend is upward, and you have to ignore the dips and stuff. And this is easier for me to say because we've had minor dips, but I haven't gone through anything as drastic as 2008 or as drastic as the dot-com bust. But you need to know that they're coming. Okay, the stock market, the general trend is upward over decades and stuff. But looking at it on a micro level, it goes down, for periods of time. It might go down for a couple of years and it might lose 50% and it can scare the crap out of you. And I'm not making light of that, but I really want you to commit to understanding that you're in this for the long run. okay? Even when it's going down, you need to just stay in. Don't sell, because that is the number one way to lose money, honestly, is paying attention to it and trying to sell and trying to time the market. Timing the market, in my opinion and a lot of other people's opinions, is just a foolish and foolhardy thing to do, that it's just not going to work, because technically you have to be right twice. You have to be right when you sell, and you have to be right when you buy. And the likelihood of that is honestly so slim, even for people that are specifically picking stocks and this is their job. It's the way to lose money. It's why when you look and see how the S&P 500 has performed over the past couple of decades, I don't remember what the rate is offhand, but let's say that it was 15%, okay, for this example. A lot of people say they were just invested in an S&P 500 index fund, which should be matching the market. If you bought and held it for that same period of time, you should be matching that 15%. But people like to dance in and out of the market, and it's so hard to time that then their returns might be 10%, 12%, or whatever. Very rarely can you time it appropriately and actually beat the market. So I stick very closely to the buy and hold mentality. And honestly, when you're young, the best thing that could happen to you is for the stock market to go down for a few years, because essentially your money is buying more shares at a time. The price of the share has gone down. If you're still investing the same amount of money, suddenly you're able to buy more shares. So that means that when it goes up again, you're going to own more shares, and it's going to be even better. So thinking about it as buy and hold, and honestly, when the stock market goes down, you are buying stocks on sale, because you don't want it to keep going up. That's just going to be expensive. A drop in the market would be a great thing right now for the young investors if you have a buy and hold mentality. If it drops and you sell it, then that is awful. Honestly, it's one of the worst things that you can do. And I'm going to link to the beginning of the J.L. Collins stock series, which honestly on the blogs and groups that I follow, whenever anybody says, I don't know much about investing, I want to learn, people link to this stock series. And Sam can vouch that I spent it's pretty long if you get into all of it. I spent a week or two last summer engrossed in it. And Sam was like, what are you reading? And I'm like, I'm still reading that blog. But his first post is basically about, not getting too skittish about the market going down. It's really at the point where it's going to go up and down. And if it crashes terribly and doesn't recover, we've got bigger problems than our retirement funds, honestly. That would be, the country collapsing or something catastrophic. So, hopefully that's not going to happen. But we're all in the same boat, and you just need to hold on to what you have.
Yeah, because if you're worried about investing and drops and stuff, this might not be the absolute best way to look at it, but part of the way that makes me comfortable with investing is if the market plummets and you're in trouble because of it, it's easier for me to remember that everybody is in trouble.
Mm-hmm.
You are not the only person that lost money. Companies are losing money. Other individuals are losing money. No one is in great shape, and so you're probably in about the same amount of shape or the same quality of shape. That's not...
Yeah.
You're in the same shape as everybody else.
You're in the same boat as everybody else.
So yeah, it's not like just you are getting in trouble when the market goes poorly.
But yeah, with that drop in 2008, it dropped and things were scary, but you haven't lost money until you physically sell. It's just...
It's a good way to look at it.
It's hard to look at that value and see that it's gone down, but you haven't technically lost any money yet while you haven't sold. Stressing a buy and hold mentality is really one of the most important things that I can do for this podcast.
Yeah, actually, I've never thought of it that way, because I always just, set it and forget it. That phrase works very appropriately for this.
Yeah, really, it's so hard mentally to get through it, but the way that they look at it is... Once again, going back to that example of, say you've invested in an S&P 500 index fund, which should technically be tracing, following the market. If that fund has increased by 15% in 20 years, theoretically that's what you should be getting. But people like to dance in and out. They like to try to time it. They go, oh no, it's on its way down. I'm going to try to sell it now. But it just doesn't work. So when they look back and see what people's returns are, they're a little bit less than that. And honestly, the people whose portfolios do the best are dead people. What does that say? That means that we are the ones who are messing everything up, because if we just left it alone, it would probably be fine. I mean, and the second best one, I think, were people that forgot about it. So that's what Sam is saying, a little bit set it and forget it. Once you start investing, don't watch the stock market. It does not affect what you're doing and what your game plan is. At least that is what I'm advocating for. There is no sense in watching it and getting freaked out. It is fun to see it go up. I can absolutely vouch for that. But in December and November of 2018, things were not going up. It wasn't that much fun to watch. So honestly, just ignore it. Stay with the path and keep investing, and don't be bothered by the minor blips or even the large blips. I mean, really understanding that you're in it for the long run, especially as someone in their 20s and 30s that hopefully don't need this money for 20 to 30 years. I mean, there's time to recover. All right, let's get to those action items. First off, budget check-in. How's that going? Have you figured out that it's a never-ending process? Is it working for you? Do you see your priorities reflected in your budget? Just keep up with it, and that's your weekly reminder. All right, 2, play around with the calculator to see how much your contributions grow. I suggest using interest rates between 6 and 10%. The Dave Ramsey calculator is fun because it clearly shows how much of your final total is contributions and how much is growth. Number 3, watch and read the recommended videos and articles. I think the 2 cents video brings up some especially good points as they compare the stock market to a casino. Spoiler alert, they're not really similar. Even though sometimes being in the stock market can feel like gambling, that's not the way that it should be. So that's all for this week on our investing mindset primer. There are a few more nuts and bolts to get into, but if you can start, like I said, working on that buy and hold mentality and setting it and forgetting it. One of the phrases that I hear often and kind of cracks me up is the typical phrase is, don't just stand there, do something. But in the world of investing, it's more along the lines of, don't just do something, stand there. So keep that in mind. Thanks for joining us, and thanks, Sam, for being a special guest.
Thanks for having me.
I feel like we're going to have a bloopers for this one now.
Oh, definitely.
I'm your host, Emily, here with Sam, and thank you for joining us as we kick off our investing series with discussing the mindset you should have for investing.
Should I say hello?
Sure, you can say hello.
Hello. What?
I don't know, it's too weird.
Yoo-hoo.
You're too weird.
Big summer blowout. It's your show. Tell me what to do.